In an economy shaped by instant notifications, algorithmic trading, and constant financial noise, this analysis exposes how speed, not ignorance, has become the greatest threat to American investors. It examines why modern markets reward patience over prediction, showing how fees, taxes, and emotional decision-making quietly drain wealth. By contrasting frantic trading with long-term discipline, the documentary explores how compound interest, automation, and psychological control outperform smart strategies. To understand why sustainable wealth now depends more on restraint than brilliance, we begin by dissecting the traps built into today's investing culture. Chapter 1. Analyzing the speed trap. You open your phone. A notification from a trading app pops up. The market is booming. Don't miss this opportunity with stock X. You see green and red candles dancing. Hundreds of % growth figures shared on social media by newly emerging experts. You feel a jolt of electricity run down your spine. That's FOMO, fear of missing out. But I have a saying for you. In investing, emotion is the enemy of mathematics. The speed trap, the modern financial system, is designed to encourage your speed. Why? Because exchanges make money from transaction fees, hedge funds make money from volatility, and brokerage firms make money from the constant changes in your portfolio. If you just bought one index and held it for 30 years, they would go bankrupt. Forensic investigations into the behavior of individual investors show that, on average, an individual investor holds a stock for only about 5.5 months compared to 8 years in the 1960s. What's the result? They always buy at the peak of euphoria and sell at the bottom of fear. They aren't investing. They're gambling against algorithmic machines capable of executing millions of transactions per second. The 10-year rule, the filter of truth. If you look at the stock market for one day, the probability of winning is only 50/50, nothing short of flipping a coin. If you look at a year, the probability increases to about 68%. But if you look at 20 years, the probability of the market yielding a positive return is almost 100%. Long-term investing isn't a tactic. It's a filter to remove the noise of emotions and harness the only power that can defeat the system, time. Chapter 2, the smart trap. Why do experts often lose? We're taught that to succeed, we need to be smarter than others, read more reports, and predict the future. But in the world of investing, smartness is often a barrier. The active management catch. Every year, billions of dollars flow into investment funds managed by PhDs in mathematics and top financial experts. They promise to beat the market. However, the SPIVA S&P indices versus active report reveals a harsh truth. After 15 years, over 90% of actively managed funds perform worse than a simple index fund. Why? Because of high management fees. Because of mistakes in trying to time the market, timing. And it's the ego of those who are too smart that makes them unable to accept sitting still. The cost of activity. Every time you execute a buy or sell order, you are creating cuts in your profits. Taxes. Selling early means you have to pay short-term income tax, often much higher than long-term tax. Spread. These tiny numbers accumulate after hundreds of transactions and will swallow up your profits. Hidden fees. Funds often have operating fees that you never see on their homepage. The philosophy of a true long-term investor is not what to do next, but how to do nothing at all. Chapter 3, the math of compound interest, the eternal engine. Einstein called compound interest the eighth wonder of the world, but Joe calls it an engine that takes time to start. The muddy phase. Most people give up in the first 5 years of investing. Why? Because in the first 5 years, your asset chart looks almost flat. You put in $10,000, after 1 year, you have $10,700. You get bored. You think, did I work hard saving all year just to earn a few $100s more? Buying a new iPhone would be better? This is where the system weighs out the impatient. Compound interest works exponentially, not linearly. Its real power lies not in the first 10 years, but in the last 10 years. Image: linear growth versus exponential growth of a long-term portfolio. The autopsy of a self-made millionaire. If you invest $500 a month at an 8% interest rate, after 10 years, you have approximately $90,000. Still normal. After 30 years, you have approximately $750,000, starting impressive. After 40 years, you have $1.7 million. Look closely at those numbers. In the last 10 years, from year 30 to year 40, your assets increased by $1 million, more than the total of the previous 30 years combined. This is the secret the exchanges don't want you to know. Most of the profit comes from persistence in the end, not from initial acumen. Chapter 4, the Iron Mind Model, when the market is an internal battle. The human brain has been programmed over millions of years to react to danger. When our ancestors saw a tiger, they ran. When you see your portfolio drop 30%, something that will certainly happen a few times in your life, your brain sends out the exact same signal: danger, run. This is the trap called loss aversion. Behavioral psychologists have proven that the pain of losing $1,000 is twice as great as the joy of gaining $1,000. The financial system knows this. The financial media knows this. They run sensational headlines. $1 trillion market evaporates, the biggest crash in history. They want you to panic, because when you panic, you trade. When you trade, they collect fees. The play dead strategy. A famous study, often attributed to Fidelity, showed that the highest profit investors were those who were dead or those who had forgotten their account passwords. Why? Because they couldn't interfere with the process of compound interest. They couldn't cut their losses at the bottom and couldn't take profits too early. To mastering the market, you need to build a steely psychological model. Accept volatility as a learning curve. The stock market doesn't give you 8 to 10% profits for free. The price you pay is psychological instability during downturns. Complete automation. Don't trust your willpower. Set up automatic buy orders, DCA, on payday. When you don't have to make decisions, you don't have a chance to make mistakes. Chapter 5, the way out. 2 philosophies, 2 destinies. To conclude this analysis, let's make a final forensic comparison between 2 familiar figures, Alex and Jordan. Both have similar incomes and both started investing at age 25 with the goal of financial freedom. Alex, the win seeker. Alex spends 2 hours a day reading news, tracking super stocks, and trying to catch the peak and sell the bottom. Behavior. Alex jumps into AI crazes, then cuts his losses when it corrects to switch to gold or cryptocurrency. Result. After 20 years, despite a strong market growth, Alex's profit only reaches 4% due to transaction fees, short-term income taxes, and missed opportunities. Alex still has to work extremely hard and is always stressed whenever the stock market crashes. Jordan, the steadfast historian, Jordan understands that he cannot be smarter than the market. He set up an automated buy order for the S&P 500 index fund and stopped checking the app. Behavior. When the market crashed in 2020 or inflation surged in 2022, Jordan did nothing. He viewed it as a discount and continued buying. Result. Jordan achieved an average market return of 10%. Thanks to compound interest and extremely low costs, Jordan's assets are 3 times larger than Alex's. More importantly, Jordan gained mental freedom. He used that time to develop his career and spend time with his family. Conclusion. Mastering the market isn't about learning to predict the future, but about learning to control yourself in the present. The system will always try to convince you that this time will be different, or you need to act now. But the truth is, the more you act, the less profit you make. Long-term investing is a tedious process, like watching grass grow or paint dry. If you want excitement, go to a casino. If you want sustainable wealth, choose boredom. Build a solid psychological floor and let time do the hard work for you. Financial freedom doesn't lie in which stocks you own, but in how long you have the patience to leave them untouched.